Mortgage prison, I think, is such a good way to describe how probably many are feeling at the moment. What would be your advice? I mean, as you said, the prediction is at least another 3 rate rises to come. So if you're a mortgage holder, what would you do?
Well, Danica, separating people into 2 different categories. Now, if you are in mortgage prison and you don't have the ability of that magical 20% number in equity in your property to go and take your mortgage and potentially find another lender to refinance to, those particular borrowers should be calling their banks immediately and speaking to their banks about potential solutions to lower their repayments. Now, for borrowers in that position, they can speak to their current bank and ask for some interest rate relief. Banks are much more compassionate these days about people in financial hardship where they don't have the ability to make their repayments. Another strategy, if you are in that position where you can't refinance your mortgage, is consider moving from principal and interest repayments down to interest-only repayments for a period of time to mitigate those potential shocks. And that could be saving you some money, over the course of this year and potentially beyond. Remembering, of course, interest-only does not pay off the home, but reduces your repayments so you can get back onto your feet. Now, if you're in that very fortunate position of having 20% of equity in your property and having the ability to refinance out, the banks are still very competitive, with banks and lenders offering $5,000 cash sweeteners to help you refinance your property and encourage you to take that step. And that could mean the difference of you potentially moving from a rate of, say, 5.5% down to, say, maybe 5% and putting an additional $400 in your back pocket each and every single month. And that adds to the savings. Danica, one of the other more shocking statistics from Australia in the most recent years is that Australians have amassed $2.2 trillion worth of consumer debt over the course of the last 20 to 30 years. And what that means is it's not just the mortgage repayments that borrowers have to worry about, but it's all those other products. So when you consider things like car loans, personal loans, credit cards and other credit products, borrowers should be looking not to save money on their mortgage, but potentially refinancing their current existing other debts into more cheaper alternatives so they can save money in those household budgets. Of course, pulling out the pen and paper again and ensuring that you're not spending more on things like unused gym memberships, subscription services, or things that aren't adding value to you inside of 2023 to reduce your overall expenditure to mitigate some of those impacts of those rising interest rates. So there's some of the hints and tips that Australians can look at in 2023. And lastly, Danica, I think just on that point, for borrowers who are feeling a lot of pain out there, there is some phenomenal resources from Financial Counselling Australia, or people that just need that somebody to talk to in this very difficult time to explore their options in a very independent way. So there's plenty of opportunities for Australians to mitigate some of these impacts. But the best thing to do is to start now and early before that mortgage pain and stress becomes increasingly overwhelming.